This short video will deal with the WoW trade. The WoW trade is an acronym for the way this type of pattern looks. It's essentially a W or inverted W, an M shape, formed once a higher time frame has been hit or price is overextended. A WoW trade is the imbalance created at the break of the trend line, right before the trend line break, or at the trend line confluence. So if this is the weekly demand, for example, because these patterns normally happen when a higher time frame area is in control, when if monthly weekly area of demand is hit, price breaks. This is, let's say, the daily trend line. Price hits that weekly area of demand and rallies and breaks the descending trend line, creating a brand new daily imbalance or other imbalances in lower time frames. So it is a new imbalance created at the break of the trend line, right at the break or before the break of the trend line, which essentially inherits the property of the one area that removes the trend line. So what essentially happens when a WoW trade occurs? First of all, WoW imbalances happen on all timeframes and all instruments. Normally price is testing a bigger time frame zone or a flip zone. Price is usually overextended. It is the case of many scenarios. More than 3 CPs happen and will have most likely formed, which is overextension after all. Price is reacting to a bigger time frame and creates a brand new imbalance. That's what the definition of WoW is. Um, and one fact that we have to bear in mind is that big rallies and drops are not sustainable. At some point in time, price will start retracing, and that normally happens when these scenarios happen. Many traders, when investors will start taking profits and all that, and will start having bigger retracements. So the WoW depicts these scenarios. Let's take a look at a couple of them so you can get the basics of the WoW. Okay, let's take a look at the euro. On the euro, we've got a clear downtrend on the monthly. So here on the way up, let's take a look at 3 time frames. On the way up, we had that ascending trend line connecting these several peaks, one peak, okay. And then once that was broken, it created a new WoW. Okay, price never retraced. So after the trend line break, it's what happens. We need at least one full open high, low and close candle, not touching, not even near the trend line. Okay, so that verifies, confirms that this is a WoW. Here, what happened here in the euro lately? Valley, valley. This is a tricky one, and this is a WoW on the monthly playing out. We go to the let's go to the weekly. Here in the weekly, we've got, for example, one valley, another valley, but that didn't make a high, so this is not valid. So this is one valid, and another one. So we connect the trend line, okay, and we've got this. So we've got a weekly area of supply WoW short within a monthly WoW short. This is confirming that imbalance. That is a WoW. This one over here. It is created at the origin of the whole drop in price, but this is also a WoW. Okay, why? Because as the definition explains, it is an area happens right before the trend line breaks or at the trend line confluence. So that weekly area of supply over there is a weekly WoW short that happens at the trend line confluence, as explained by the rules. Then later in time, like a couple of months later, that area is retested and we took some trades on the way down. Okay, so now we went higher into monthly area of supply and that's the area of WoW short in that area, and then price retraces again. And as you probably know, remember the scenario, probably you won't remember it if you see this video in a few months time. We took a short right there, okay, and we took shorts there as well on the PCPs. On the daily, same thing. If we get several valleys and peaks, and once that trend line is broken, then we're gonna have WoW. So we've got a valley, another valley. We connect those, and there we have our WoW. Okay, confirmation of this area, which is the weekly area of supply. All this is the weekly area of supply, as I remember. So here the same thing. We've got several valleys. Valley, valley. So that's the W shape, as you can see. Okay, W. And when we do that for the opposing, instead of a ascending trend line and a descending trend line, this is what we have. Okay, two peaks, and then we've got an M shape. So we've got a W shape, M shape. So get the O, and then we've got a WoW warm setup. Okay, so here we've got the ascending trend line. This is a trade, daily WoW short, but price never pulled back here. If you would have pulled back there, then it would have been a great trade. But it pulled back into the area right when this was confirmed as a weekly area of supply nested within this whole monthly area of supply. WoW short. So this is a daily WoW short nested within a weekly WoW short nested within a monthly WoW short. Okay. This was going to be covered in another video, but it just happened to happen here. So I will repeat this in the video of nested WoWs, which are high probability. And this is it. Every time there is a trend line break, we've got a WoW area. So the tradability of these any brand imbalances depends on the trend, on the bigger picture, multiple time frame analysis, and your sequence. Because the high probability WoW setups go with the trend, like this one. Monthly still up, 3 months down, so monthly still down, 3 months down. So when we get WoW short on a weekly, daily, and monthly, then our bias is going short. Okay, that's it. Hopefully this will be very clear. Thanks a lot.